In this video, I'm going to show you how to use options as a safe and reliable way to generate positive returns in the market. Too often, options are being used as a way to risk everything and go YOLO, but options can actually be used in a much safer way. That's why I wanted to show you a strategy where you are basically getting paid to wait. So let's get into it. You probably are familiar with the concept of buying options. However, you might be less familiar with the concept of selling options. Selling options consists in creating an option contract and selling it to someone else and receiving a premium against it. So let me show you an example so it's clear. When you buy an option, you're going to pay a premium and you're going to receive in exchange the option that you wanted to buy. So for example, if you want to buy a call option, you're going to pay a premium, and then against that premium, that price that you're paying, you receive your call option. So for example, if we have a buyer and a seller, that's exactly what happens. Let's say that the buyer wants to buy a call option. For example, he's going to pay a premium of, let's say, $100 to make it simple, and in exchange, he's going to receive his call option. That's how it's going to work. But obviously, when you're buying an option, you're paying a premium to someone, and that's the option seller. And the option seller is taking the other side of the bet. So he's receiving the $100, and in exchange, he's giving you that call option. And when you're in the position of the option buyer, we said that you're buying to open because you're opening a position, you're buying a call option. But when you're in the case of the option seller and you actually sell an option to someone, we said that you're selling to open. You sell an option to someone and you receive a premium against it. And what's really good to know is that when you're selling to open options, you're receiving premium directly within your account the moment you sold the option. So let's say, for example, you right now, you're willing to sell an option, selling to open an option. If you, for example, decide to take the seller's position, you're going to sell to open an option. For example, you're going to sell a call option to someone who would like to buy it, and you're going to receive that premium directly in your account. The moment you execute the transaction, is going to arrive in your account. But the question is, why would you want to be in that situation? Why would you want to sell to open an option? Why would you want to be in a position of an option seller? Being in the position of an option seller can be extremely beneficial, and here's why. For example, let's say that you're willing to buy Twitter shares. So the ticker symbol for Twitter is TWTR. Right now, the current stock price, I'm going to put S, is around $45 per share. So that's the current stock price. If you were, for example, willing to buy 100 shares of Twitter at $45 per share, then that would be an investment of $4,500 because you're buying 100 shares of Twitter at $45 per share each. So $45 times 100 equals to $4,500. You could absolutely buy those shares now if you wanted to. You could absolutely buy them right now and pay $4,500 to buy 100 shares of Twitter at $45 per share. You can do this. Or you can use what we just talked about before, selling options, so as to not only get a better price at entry, but also being paid to wait. And here's how it would work. Instead of buying 100 shares at $45 per share at the current price, you can sell an option at a strike price at which you would be comfortable owning the shares at, and in exchange, you're going to, on top of that, being paid to wait. So if you are deciding now to sell an option, let's say at the $40 strike, so you're going to sell an option at the $40 strike, and you're going to sell a put option. In exchange, you're going to receive a premium. So you're going to receive, let's say, a premium of $150, for example. If Twitter stock goes below $40 per share at expiration, then you will have to buy 100 shares of Twitter at $40 per share. So you will need to provide an investment of $4,000 because $40 times 100 equals $4,000. But if Twitter stays above $40 per share at expiration, then your put is going to expire worthless, and you can just do it again and then collect another premium and make more money that way. That's what we call selling a cash secured put. You're going to sell a put, and we call that cash secured because you have enough money in your account so as to cover the assignment, so as to buy 100 shares of the stock if it was falling below your strike price at expiration. So not only you're going to end up owning a stock at a lower price per share compared to if you were buying the stock directly, but on top of that, you're also being paid with the premium that you're collecting when selling selling that put option. So not only you're going to own the shares at $40 per share and so pay $4,000 worth of shares instead of 4,500 at the beginning at the current stock price, but you're also going to collect $150 of premium. Hence why this is a great strategy, because you're being paid to wait. You're being paid to wait for the stock to go down below your strike price so you can enter at a better price per share. And on top of that, you're being paid for it. Quite cool. So to show you how that would work if you were using, for example, your broker, so I use Tastyworks, for example, you would go on Twitter, and then the first step would be to choose an expiration. So to help you choose your expiration, think of it that way. Think of it as what would be the timeline at which you want to end up owning the shares or not. If I, for example, go, let's say, for the December 17th expiration, which is the first one, it means that if, for example, Twitter is below my strike price by December 17th, then I will need to buy 100 shares of Twitter at my strike price. But you can also go to a later expiration if you want to. So let's say that I go for the January 21 expiration. So right now, I'm going to sell a put option in the January 21 expiration. Then once we've chosen the expiration comes the strike that we need to choose. So to help you choose the strike, think about it that way. The strike that you're going to choose is going to be the price per share at which you're ready to own Twitter at, or any stock that you're willing to sell cash secured puts on. So as I said before, for example, if I sell a cash secured put at the 40 strike and I click on the selling the put option, I'm going to collect a credit of 78 cents for selling a put option at the 40 strike on Twitter. So that means that I'm going to be paid $78, because 78 cents is for one share, but as one option contract controls 100 shares, then 78 cents times 100 equals $78. So I'm going to make $78 by selling that put option instantly, like the moment I'm going to press send and my order is going to get filled, I will have $78 more in my account. And in exchange, I'm selling that put option to someone who is willing to buy it. So that means that if Twitter goes below $40 per share by January 21, then I will need to buy 100 shares of Twitter at a price per share of $40, meaning an investment of $4,000 as I'm buying 100 shares of Twitter. And if it stays above $40 per share by January 21, then my put option is going to expire worthless, which is not a problem. You can just keep selling another one if you want to and make more money like this. So you see that if you're willing to own a stock, then that strategy is probably the safest strategy that you can use when trading options. You wanted to own the stock anyway, so why don't you sell a cash secured put on the stock, have a better entry price if the stock falls, and on top of that, you're being paid to wait. You're being paid to wait for the stock to go down. But you don't have to sell, for example, the 40 put on Twitter if you want to. Instead of, for example, selling the 40 strike, you're going to sell the 42 put. Now you're going to receive $1.20 per share, so $120 for selling that put option at the 42 strikes. So now if Twitter falls below $42 per share by January 21st, then I'm going to have to pay $4,200 to buy 100 shares of Twitter at a price per share of $42. So it's up to you to see which price are you actually comfortable owning shares of Twitter at, for example, in the case of Twitter. But of course, you can choose any stock that you want to own, like as long as you're willing to own the shares at, then you might as well sell a cash secured put and make even more money on top of that. But here's the problem that I can see with that strategy. When it comes to using that strategy, you need to understand that you have to be ready at some point to own 100 shares of a stock. So that can represent actually quite a lot of money depending on the stock that you're trading. For example, if you're willing to own 100 shares of Tesla and it's around $1,000 per share, then you will need to put $100,000 on the table to buy 100 shares of Tesla. And it's not everyone that has this type of money. So what can you do if you have a small capital, but you still willing to use the cash secured put strategy? Well, I used to have this problem myself, and when I started out, I really didn't have much money, I didn't have much capital, so I had to build myself a watch list of stocks that I was willing to own, and then I would sell cash secured puts on those cheap stocks, so it was a lot more affordable to me. And instead of paying 100 grand to buy 100 shares of Tesla, I was only paying, for example, $2,000 on a $20 stock because the stock was so cheap. And that's what I think is really the best advice I can give to someone who is willing to start with that strategy is to go for cheap stocks. And you can use the watch list that I built. I will put the link of that watch list in the description of this video if you want to check it out. But my opinion overall on the cash secured put strategy is the following. It's a strategy that is extremely good for the following reasons. It's very mechanical. It's very simple to understand. As you saw in the video, either the stock is going up and your put expires worthless, or the stock is going below your strike price at expiration, and then you have to buy 100 shares of the stock. But that's not a problem because you wanted to buy shares of that stock anyway, and you're just ending up owning shares at a lower price per share compared to if you had bought the shares directly. You're making money from different sources of income. Not only you're going to probably earn money by having the value of the shares increase as the stock price increases, but also you're earning money by selling puts. And that's a much better way to trade options rather than trying to, for example, buy options and go YOLO or try to do some very risky things. By selling cash secured puts, you're trading options in a much safer way compared to someone who would go YOLO, and there's actually much more thought and strategy behind it. And to tell you how I started, when I really started getting into options and I really wanted to understand how they all work, I really focused on that strategy, the cash secured put strategy, to fully understand the mechanic. I was trading cheap stocks. I was, for example, trading American Airlines, which I'm still trading to that day, by the way. I'm actually selling cash secured puts on American Airlines still to this day because this is a cheap stock. It's around $20 per share. I mean, if you have to buy 100 shares of American Airlines, it's around $2,000 that you have to invest. So it's definitely more affordable. And I used that strategy on cheap stocks so as to get a hand on options and understand more how they worked. And I think for beginners, that's one of the best strategies that you could actually start with. Please make good and informed decisions. I'll see you in the next video. And in the meantime, I wish you all the best.